All right. Happy Fed Day, everybody. 75 basis points. Just hit the tape. How are you magnificent melon heads all doing today? Happy Fed Day. It is that wonderful time when our benevolent government overlords at the Federal Reserve get together and they tell us how much more expensive they're going to make our life, all the while gaslighting us about how they feel our pain because, you know, they're just like us. Well, that all starts in just a couple of minutes. Now, it was just a few minutes ago before we went live that it hit the tape. The Fed has hiked by 75 basis points or 0.75%. They've raised interest rates. And you can see in this chart above me right there, the S&P 500 did not like what it heard. Now, that's interesting that everything is selling off that way right now because 75 basis points was widely considered to have already been priced into markets. And there was actually the possibility of that 100 basis point hike was out there that we didn't get. So I would almost expect a little bit of a rally on this news, but that's not what we're seeing right now. I've also got a couple of charts up behind me as Jerome Powell is speaking, which will start in about a couple of minutes here. I'm going to be cycling through these charts. We've also got the DXY or the US dollar index. Man, big jump up in the Dixie right now at 111.47. We were at 111.5 just a few seconds ago. I tell you, stocks do not like that. Remember, when the dollar goes higher, the stocks and the commodities that are priced in dollars will go lower. So this is, well, there's that dollar milkshake theory continuing to play out. Also, we've got the U.S. 10-year yield now at 3.6%. That is the highest we've been really since the immediate aftermath of the global financial crisis. I think maybe around 2010, 2011, we were up this high. It's been a long time since we've been at 3.6. So the price of money, folks, is going higher, and we live in a debt-based economy, so this is not good for business, not good at all. Gold prices initially sold off hard on this news, although we're seeing gold bounce back just a little bit right now. Now, a chart like this is a good point where I want to warn you guys, I don't usually trade in the immediate aftermath of a big decision like this, a Fed decision or a CPI read, because the algorithms take over. And the price moves are so fast, especially if you're out on leverage and you have things like stop losses or margin calls to worry about. You can really get in big trouble trying to out-time the algorithms. You can't keep up with them, trust me. So I like to just sit back and watch right now, and these candles are just huge that I'm seeing coming in. The Dow is currently down 274. It was, and it looks like it's heading lower at 30,400. We've also got West Texas Intermediate Crude at 82.73 heading lower. We've got the NASDAQ getting punished pretty close to the low of the day right now at 11,300. That's down another 113 points. Silver's selling off again, doing the kind of the same thing that gold is doing, although still up for the day in silver. But big red candle down right at the start there. And we don't need to get into the bonds right now. By the way, I am remiss. I got to say hi, Mom. Hi, Dad. I love you guys. Thank you for watching. And thank you to all the regular folks who are watching. And anybody who's new to the channel, won't you please like and subscribe while you're here? We do this every time Jerome Powell speaks. We bring him up on the screen behind me here, and we react in real time. And then we'll hang out for a couple of minutes after Powell's Q&A with the press, and we'll talk about what he heard. Now, the market is expecting straight up hawk J Powell today. All right, if we get anything but hardline hawk from J Powell, I would actually expect a little bit of upward movement in stocks right now. So that's important to keep in mind. What we're seeing right now, all this big red, all this red that we saw after the big disappointing consumer price index that we got last Tuesday, it's all anticipating hardline hawkish J Powell. So keep that in mind. Right now, anything short of hardline hawk should be good for stocks, should be good for prices. All right. Now, with that in mind, I think it is time that we said hello to my man, Mish the Mod, who is lingering in the background right now. We can't see him, but he's listening. And Mish was going through the data as only Mish can do. And he came up with a couple of other things about the dot plots and some of this other stuff that was going on that I found very interesting. So, Mish, how are we doing today? Mish did not find his mute button.
Wow.
There we go.
That mute button. So, hey, how you doing? I'm in Little America, Wyoming today. It's a little west of Green River, Wyoming.
And how are the little Americans?
They are doing well.
They're doing
It's
good.
a nice little place, man. It's hotel, truck stop, deal. They all rolled into one.
Well, I would expect it to be a little place, aptly named. So tell me, Mish, what did you find when you went through the data? Now, you were reading some stuff from the press release. Beyond the headline, the 75 basis point number, there were some more details in there that were pretty big.
Right. So, part of the job, we follow some pretty esoteric people on Twitter. But someone had sent me this right at the time it's coming out in chat. So let know chat was talking about this a little. But at the end of 2022, the Fed has raised their expectation inflation from 4.4. I'm sorry, not inflation, Fed funds rate from 4.4 from 3.4 previous to this meeting.
So they're basically saying another 100 basis points before the end of the year.
Yes, sir.
Okay, so that's big because we just got 75 after the previous 75, and we have no FOMC in October, so there's only 2 meetings. So the Fed now, and this is the dot plot they're talking about, right? So this is like the average opinion of all the governors. Some are higher, some are lower. So they're saying at least 2 more 50 basis point hikes in the next 2 meetings, which are November and December. And I would just mention that there's always a little optimism baked into these numbers in the dot plot because we've seen as inflation has continued to disappoint and as we've been raising, these expectations have been raising right along with them. So that's pretty significant to see another 100 basis point increase in the dot plot. That means more hikes ahead. And maybe
right. And that in 2023, they're going to be up at 4.6, which is a 0.8 increase also for next year.
Okay, so they're projecting
another quarter point.
Yeah, they're projecting further hikes, maybe like another quarter point in 2024, which I'm sorry, that's at the end of next year. So that's interesting. Yes. If they're saying only another quarter point after this year, so that
would be January.
Yeah, but that would you call that the pivot when they're done hiking, or that they're going to get there and they're going to stop?
Remember,
I'm not sure I'd look too much into
for
that.
7 months before they do anything, right? Once they stop hiking,
right,
they're going to sit on it, and then they're going to start lowering. So, they could actually do a 50-pointer and then bring it back down at the end of the year, and that's it. Something else I did see in there is they moved the GDP for 2022 expectation from 2.1 to 0.2.
And I would say that is a freaking fantasy, because I am going to go out and say there is a 0% chance of economic growth next year. 0% chance.
Well, this is this year's.
Oh, this year's.
Yeah.
Well, we're 2 quarters deep and we've already got negative growth.
Right.
And, we're currently, the Atlanta Fed's GDP Now tool is currently predicting 0.3% growth for this current quarter, and falling. And I was looking at some of the data points that remain between now and the final read for this quarter, and nothing is really encouraging there. Well, their projections, go back in time a year and a half, right? They were saying no rate hikes through the end of 2023 a year and a half ago. And here we are. What is this, like the 400th point of hike? So the Fed's projections are rather doo-doo, if you don't mind me saying. And, while we're here, I got to bring in my man, Mike Binder. Thank you, Mike, very much for the super chat and the support of the channel. I see you're cutting off my chin there. Sorry, my chin is huge. It takes up too much space on the screen. Mike says, hi, Jack. Great speech from Joe at the UN today. Note sarcasm. Did you see that 7% 1-minute candle on Bitcoin a few minutes ago? Volatility incoming. It's interesting, 7% 1-minute candle on Bitcoin. Now, Bitcoin, thank you very much, Mike, by the way, for the support of the channel. Bitcoin is incredibly volatile. And while Bitcoin is typically viewed as an inflation hedge, and, the problem is there's so much leverage and there's so much debt. Bitcoin crypto as a whole is basically now a derivative of the debt market. As long as Tether and all of these DeFi platforms are out there doing the shady business that they're doing, Bitcoin is going to trade pretty much like these other assets that we're seeing, where higher interest rates is bad for crypto. So it shouldn't be like that, but all of this creepiness of the establishment financial system has crept into Bitcoin, and unfortunately it's now functioning as a derivative of the debt market. So I'm not surprised to see a big leg down in Bitcoin on this news. Thank you again, Mike, for the support of the channel. And I got to say thank you to Steve. Thank you, sir, for the support of the channel. Says the effect of interest rates hit the consumer with a 6 to 12 month lag. I agree with that. So we're currently only feeling March rates of 0.25, future pain ahead. That is a very interesting point. Because I'll tell you, the interest rate hikes, they hit the housing market right away. They hit the cost to borrow, but the consumer, I think you're onto something, Steve, that the consumer, it takes a while for that effect to come through. So that's an awesome point. Great comments, both of you guys. And thank you very much for the support of the channel. I never thought of that. We're only seeing the most recent, the effects of the most or the earliest hikes right now, the one for March, because there's been a lot of hikes since March. I don't know how many 100 basis points since March, but it's a lot. All right, we are 4 minutes out, folks, from Jerome Powell's press conference starting. I will go on mute for most of the time when Powell is talking, unless he says something very profound and very unexpected, in which case, I'll come off of mute and I'll interject real quick. I'll try not to step on Powell too much. And then afterwards, we'll give our reactions. And let's just check real quick what's going on over at the Fed here. They're saying, got some upbeat mood music over at the Fed. Lovely stuff. Lovely elevator music from our benevolent overlords at the Federal Reserve. Powell is not out talking yet. As we get closer to 2:30, I'll start refreshing the windows a little bit more to try to get everything going there and just, see if we can catch him as soon as he comes out. Okay, let's go through a little bit of the charts above my noggin here and just see what else is going on. The U.S. dollar index now at 111.35. So it's still bouncing around, but near the high of the day. U.S. 10-year Treasury now at 3.57. That's well off its highs. That's interesting to see that coming down right now. Gold is recovering a lot of that initial sell-off. Again, folks, this chart right here. Look at this big red candle, and now the green candle's up. This is why I don't try to trade against the algorithms after a market-moving event like this. You'll never keep up with it. I mean, the swings are just too big. I mean, close of the day. So a whole lot going on in markets. Let's leave it on the NASDAQ for a little while. The NASDAQ should be the most sensitive to what goes on in the debt markets. So there. And I have to send a shout out to There Is Only One Way, who says, Googling the nearest suicide pod near me. Please, sir, do not do, I shouldn't even say that word. I think I probably just got myself flagged. Please don't do that. And it's only money, folks. Let's just leave it at that. All right. Trust me, it gets better. All righty. Moving on. We are now at 3:28, 2 minutes out. That's something going on here. Okay. I just have to leave this here. I mention this every month or every other month when Powell talks. It's not supposed to work this way. Right? We're supposed to have free market capitalism. The free market is supposed to determine the price of money, which is what interest rates are. We're not supposed to have these unelected bureaucrats who make decisions that are this important. And folks, what we're about to see today, these next few minutes, the whole world is hanging on the every word of what this one man who is not elected is going to say. All right, this guy has too much power. It shouldn't be like this. We did not have a Federal Reserve until 1913, I think, in this country. We were getting along just fine without it. We don't need it. And that's why I always include the hashtag and the Fed with these live streams, because it is not supposed to work these way. We have a mechanism for determining the price of money, and that is the free market. We should use it. It shouldn't be up to these guys. The Federal Reserve has created this inflation that they're now going to create a depression in order to fight the inflation that they created. All right, they're just playing whack-a-mole. They just make things worse every time they do this. And it's not supposed to work this way. And while we're at it, share this video, folks, because what I try to do when Powell is talking, I try to put these into terms that everyday people can understand, because this is so important to what happens in the lives of everyday people. They may think it doesn't apply to them, but it does. So please take a moment. It's right down below me. Hit that share button. Put this out on Twitter, on Facebook, out on YouTube. Share it with your friends, because this will affect them whether they think so or not. They don't realize how much of an impact this has on their lives. All right, it's 2:30. Let's see if they are playing yet? No, we don't have it. Dare I hit the refresh button? And Powell is... Here we go. Here comes Jerome Powell. He should be out any minute. We have got all of the press heads are in attendance here. Questions ready to lob softballs at this guy. I will be going on mute as soon as Jerome Powell starts talking. And look for any mention, anything even remotely dovish should be good for stocks. Here's Powell.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate.
He's building up to a recession.
Despite the slowdown in growth, the
describing.
labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation.
And dumping 1 million barrels a day from the SPR.
The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The
Markets
historical
coming
record
back
cautions
now.
strongly
Stocks are
against
moving back
prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done.
He wants to reassure us he's a hawk.
The way we're thinking
he's
about
saying
this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time.
He's saying it's a good thing that your
what will we be
pay hasn't
looking at,
gone
I
up
guess, is
even
your
though
question.
inflation is
So
high. So
we'll be
they're
looking
going
at
to
a
keep
few
at it.
things. First, we'll want to
What
see
he just
growth
said.
continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
We're a long way
Thank
from
you,
2%.
Mr. Chairman. Steve
folks.
Leisman, CNBC.
A long way.
Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy?
They're worried about the
and
Fed
give,
overshooting
time to
and
catch
causing
up,
too
in the
much
real
tightness
economy.
here.
The rate increase time to catch up with the real economy. Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are
maybe the $7
these
trillion
are the
you
kinds of
printed
events
too.
that are not
I
really
just throw them
seen
out there,
in
Jay.
prior business
Maybe
cycles.
that has something to do with it.
And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
He said more labor supply there.
Still
That's
at the
big.
top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick?
More labor supply. He's talking about forcing people back into the job market by hardship
Nick
or
Timmerus of the Wall Street Journal.
unretirements.
You said not too long ago, in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for
the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that
In other
tells
words,
us
they
is
haven't made a dent
that
in
we
inflation.
need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down.
Inflation is too
That's how
high.
we think about it.
So glad you're here to tell us these things, Jay. Up yourself to another $1 million. Good job.
Hi, Victoria Guido with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side?
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Pretty sure he just said he's not going to deliberately crash the housing
Neil
market,
Irwin with
at
Axios.
least not right away.
A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Precious metals are rallying now. They're
Craig
hearing
Torres
dovish
from
comments
Bloomberg.
here.
Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening, but you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now the data sort of are showing that
What economy
growth
is he talking about right now?
is going to be
Talking about
below
our
trend
economy?
this year. We think of trend as being about
Anyone?
1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions.
Below
for the
trend,
American
it's
people.
negative. There is no growth.
Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
But how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris, Rugaber.
A lot of focus on how will you know you went too far. They're worried about him crashing
I wanted to follow
markets
up
here.
with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So,
And so the only
that's what we're
logical
hearing from
conclusion is
people
to kill that
you know,
person's job.
Very much
Right, Jay? That's what
that
you're saying?
inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, you know, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, you know, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers
That's your job.
large
You
benefits
suck
to
at it, Jay.
society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, you know, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections
You just
today
say wages come
is
down?
that inflation
You heard
moves
that right.
down, you know, significantly over the course of next year, and then more the next year after that. And you know, I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that, you know, that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs. And we talk about that in our meetings.
But his projections are never right.
Quite a lot.
Ever.
But
Not ever.
at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, anyway, expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
I think he just took credit for
What is that
outsourcing.
economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. You know, higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, you know, down the road again, and doing it at a time when actually now people have really come to expect, you know, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now, and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, you know, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where famously, houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For
Rents
the
are
longer
up like
term,
30%
what we need
year-over-year
is
across the country.
supply and demand
What
to
is he
get
saying?
better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market. As you know, it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
He just admitted home prices have to come down. That's rare for him.
Shelter
was
made
rare.
up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Reminder, the government lies to us about shelter inflation with owner's equivalent rent. It is
Hi,
grotesquely
Jean Young with
understated.
Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point,
Pretty
which
big
could be
assumption,
1% or so. But I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right. So that was an unusually brief speech by Jay Powell. Cheeseburger, that's what you missed. You missed an unusually brief speech, and you missed an unusually long Q&A. He spent a lot more time talking to reporters than he usually does. Now, you'll notice the markets made a pretty big, pretty substantial move while he was talking. We were initially way, way down, abrupt reversal, and now way higher. So I was very, very surprised to see that because I didn't hear a lot of dovish behavior from Powell. So I mentioned earlier in the stream how we're supposed to, or how the market was expecting an absolute hawk from Jay Powell, and anything short of an absolute hawk, and we might get a little bit of a rally. And I think that's what we saw. So give me just one moment here. Let me get rid of my Fed window, and let me get rid of my charts so I can do this the right way. We're going to expose all the flaws in my green screen now. Make me a little bit bigger here. And let's do a sharing of the screen. So I can bring my charts back up here. Let's share my charts here. All right.
Well, I think what I noticed is some people ask some questions about why, if he's being hawkish, why is everything going up? People are trading on expectation right now. This is what they expected, and he came across, I think, what people expected in his speech.
So we're looking at the S&P right now. You want to know why we rallied a little bit while I was talking? Look at what it's done over the last week. Okay, so let me make sure you guys can see all right on this chart here. Okay, so over the last week, we have sold off in the S&P, not counting today's move, what was it, something like 230 points since that CPI report came out. So the market was expecting, like I said, absolute hawk. So the market was already priced for absolute hawk. Now, what they got was hawkish, but it was not absolute hawkish, right? He left a little wiggle room for a pivot, just a little bit. It wasn't a lot. I would not call that a dovish speech by any measure. But he left just enough wiggle room that the market said, maybe there's a chance Powell's going to ease up on us, and so it rallied. So the market is always looking forward. It's not looking at what Jay Powell just did. It's looking at what he's saying he's going to do next. It's always a forward-looking mechanism. So, geez, that's what you missed, I guess, while we're on the subject of your super chat. So, unusually brief comments. Now, there's a couple of things I want to highlight that he said here. He reminded us that, what was it? He referred to his Jackson Hole speech, and his Jackson Hole speech was widely recognized as, wow, that was really hawkish, almost like he put the market in its place. It was about a month ago when he gave his speech at Jackson Hole. It was really short, and he was like, no, there is no pivot coming anytime soon. I want to be emphatically clear. I'm paraphrasing here. And the market sold off hard on that news. Right? That he harkened back to that, and he just said, look, just in case you guys interpret what I'm about to say as dovish, I want to remind you of what I said at Jackson Hole, and that has not changed. So that's an important takeaway. He doesn't want the market to view this as dovish. All right, so he didn't want the market to rally like it did. I found that was quite interesting. He did mention that further hikes will be necessary and that the Fed will act purposefully, with purpose, whatever his words were. Again, I'm paraphrasing here. So, again, he's saying, I'm not done yet. I'm not done hiking. I'm going to keep raising rates. I'm going to keep up the QT. Now, there wasn't a lot of talk about QT. That was interesting because it was just last week, remember, we doubled the rate of quantitative tightening from $47.5 billion a month to $95 billion a month. There was almost no talk about that. They did mention mortgage-backed securities a little bit, and because the Fed has been kind of behind in rolling off the mortgage-backed securities. They're supposed to be doing, $30 billion a month now in mortgage-backed securities, according to their target. But because refis are so slow, that's not happening. So they were asking, are you going to sell your mortgage bonds, which would send interest rates on mortgages significantly higher than they're already going. The 30-year mortgage hit 6.47% today. So he said, we're keeping that one on the sideline for now. We're not going to do that. So he said, I'm not going to intentionally crash the housing market. That was somewhat dovish. Maybe that could explain a little bit some of that green candle. But then he came out and said later on that a housing correction is needed. That was interesting. He's never said that before. He's never outright called for the price of something to go down. Not an asset class anyway. He's never said, I want stocks to go down. He's never said, I want gold to go down. He did say he wants your wages to go down. Did anybody catch that? Was that a slip? I didn't hear. I heard that, right, Mish? That you heard that too? That he wants wages to go down.
I heard that. There's actually two things I heard. One, he said wages wants to go down and the houses need to go down, which are both deflationary. But wages, can you imagine sitting there at a desk and the employer comes up and goes, hey, we're going to have to drop your wages by 15%.
Yeah, after he said that, after he talked about how I feel the pain of the average person who spends his whole paycheck on gas and spends his whole paycheck on food and rent, which I lie to the public about how much it's gone up. And then in the next sentence, he said, we want to either destroy that guy's job or make sure he earns less money. Well, he's just like us, isn't he? He feels our pain. He's just a regular guy. He really said that. I couldn't believe that he said he wants wages to go down. He had no problem, folks. Keep in mind, he spent all of 2022. He spent all of 2020 and 2021. He spent 2 years printing money inflating asset prices. He had no problem with inflation whatsoever when it was making him rich. Remember, he sold all of his stocks in August of 2021. So inflation, the way inflation works, first it hits assets, then it hits consumer prices, and then it hits wages, right? That is the natural cycle of inflation. Wages is the last thing to go up. He had no problem with inflation when his expansion of the money supply was flowing into assets and he was getting rich. And then right before he stopped expanding the money supply with his money printing, he sold all of his stocks. He cashed out, and then he started his taper and his QT. Then consumer prices exploded higher this year. Consumer prices were going higher and higher all through 2021. Do you remember transitory? Remember that? He told us he had it under control and it was going to be transitory, as long as it be temporary, nothing to worry about, folks. Now that it's finally hitting wages, and keep in mind, wages are going up a whole heck of a lot slower than everything else is going up. But now he's got a problem. Now he needs to make sure that he kills jobs. And now he needs to make sure that your wages don't go up. I mean, just you can't make this stuff up, folks. I got to send a shout out to Colorado Crypto Chick 111. Thank you very much for the super sticker. It doesn't come up through StreamYard here, but she sent me this namaste little character saying thank you. Well, you are very welcome, Colorado Crypto Chick 111, and thank you very much for your super chat and for your support of the channel. I appreciate that very much. Thank you kindly. And who did I miss? I saw somebody else came across here. Where are you? I'm scrolling. There we go. Wonder with the pronouns says, thanks for the stream. You are very welcome, Wonder. Thank you for watching the stream. Please like and subscribe to the channel. We do this every time Powell talks. We also live stream CPI reports, GDP releases, and we do our regular weekly live streams on Tuesday morning and Friday afternoon. And of course, every now and then we release our shorter videos that are, some folks like the hour-long streams, some folks like the shorter videos. We do it all here, folks. So thank you very much, Wonder, for the support of the channel and for your time. Please, folks, remember to like and subscribe while you're here. And also, I have to send a shout out to my Patreon supporters. Thank you guys so much for your support of the channel. Reminder, my Patreon Zoom meeting is coming up today at 7 p.m. Eastern Time. I'm looking forward to talking to you guys. Once a week, I get together with my Patreon supporters, and we do a smaller group meeting over Zoom. It's interactive, two-way. It's not just me on my soapbox talking. I take your questions directly, and we'll be doing that at 7 o'clock tonight. Link down in the description if you feel so inclined. And there is Miracle Oil. Thank you very much, Miracle Oil, for the super. Says, Jack, does this pass your sniff test? Will you enter a put? I guess will you enter put means will you short the market here? I'm not going to make that decision on the air right now. It's hard for me to say. Let me just say I'm very close. I did not hear anything really overtly dovish in that statement. And the fact that inflation is still high and the fact that I think energy prices are going significantly higher as soon as the dumping of the Strategic Petroleum Reserve ends. Also, the fact that Powell is paying so much attention now to shelter costs tells me maybe they're going to start telling the truth a little bit more about owner's equivalent rent. And there's a lot of pent-up upward pressure on CPI from owner's equivalent rent that if they ease off on the BS a little bit, that will take CPI higher. So I think there's a lot of things to take this market lower right now. So I will probably enter a put, although there's more. I got to look at the technicals. I got to wait for all these crazy candles that are going on right now to settle down. So hopefully I'll have more on that subject very soon, Miracle Oil. But I'll just tell you this, nothing I saw today really changed my mind about the direction of markets. I can say that definitively. I heard nothing that changed my mind here. I would not interpret this as dovish, although it wasn't like gung-ho, guns a-blazing, hawkish either. Maybe that's why we're getting a little bit of this volatility right now, and the market doesn't really know what it wants to do. But that's my 2 cents. Thank you very much, Miracle Oil, for the super chat and the support of the channel. I really appreciate that, guys. Thank you for your generosity. And there is my man, Dan is back. Thank you, Dan. Says, all I hear from him is blah, 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 blah. I'm a dirty tramp. Yeah, I heard about the same thing. Funny how they never ask him about how the White House policies are driving inflation. Well, all right, Dan, I will say the White House policies are not helping with inflation, not at all. A little bit, the dumping of the SPR is helping now with inflation, but at the expense of future inflation getting worse. All right. Now, that being said, I have to back off a little bit on the partisan thing here because, listen, the previous administration is not innocent in this inflation, not by any measure. All right. Under Orange Man, inflation went up significantly. Maybe the CPI readings didn't go up, but the money supply expanded dramatically under Trump. Remember, Trump, he really pushed for Powell to stop raising interest rates and to stop quantitative tightening back in 2018 and 2019. Remember all the tweets about how Jerome Powell was draining money from his economy and hurting his stock market, right? So Trump was pushing for Powell to be more dovish years ago before the unfortunate health situation. And then, look, Orange Man, he dumped trillions of dollars into the market with stimulus as soon as the lockdowns and everything else happened. So I can't put this one all on Biden. Biden has certainly played a big role in it. All right. And all of the stimulus spending and the Inflation Reduction Act will not do anything to reduce inflation. If anything, it will make inflation worse. So, but I have to say here definitively, they both sucked. All right. When it comes to the expansion of the money supply and what has caused what we're living through right now, neither of them is innocent. Both parties have done this. Both parties are reckless spenders. All right. One party talks a big game when they're not in power, and then they get in power, and then they spend every bit as much as the other party did, right? That hasn't changed, not for 20 years, right? And now we're all living with it. Now, to your point, you did get mentioning a little bit, and you kind of gave me a good segue there, Dan. By the way, thank you very much for the support of the channel and for your super chat, sir. I appreciate that very much. Powell mentioned, what was the comment? I wrote it down. He said, we got inflation under control, and so we had this long expansion, one of the longest expansions in history. When he says that, I think he's referring to we got inflation under control back in the early 80s. And then we did have this long economic expansion period. We had some recessions, right? The GFC and a couple of other, the dot-com bubble, some shorter recessions here and there. But then we had this really long economic expansion from like late 2009 all the way through. If you take out COVID, it was a very long expansion. I probably just got my channel in trouble when I said the C word there. But he's taking credit there. All that while, that whole economic expansion, it was paid for by easy money, by low interest rates, and by the expansion of the money supply. Right? It was paid for with inflation. Now, we didn't feel that inflation because while that massive expansion was going on, we were outsourcing our expensive labor overseas to Asia, where things could get built for a lot cheaper and then bring them back here. So our consumer prices weren't going up, even though the money supply was expanding like crazy, because we were taking advantage of cheap labor overseas. It's not to say they did anything right. There was just this global trend that was masking everything they were doing wrong. Well, now globalism is in reverse, all right, with the invasion in Ukraine and with since the trade war started before the unfortunate health situation, and then the supply chain breakdowns during the lockdowns, and now the geopolitical tensions between the West and the East and U.S. and China, the world is deglobalizing. So that labor trend of all that cheap labor going overseas is now in reverse, and that cheap stuff now has to be made here where the labor is much, much more expensive. Now, while that may be good in some ways, that will drive wages higher, right? That'll bring more jobs here. That's also going to be very inflationary. So that inflation that Jerome Powell, he took credit that it never happened over the last 10, 15 years. That's all coming home to roost right now with the world deglobalizing. So I found it a little ironic and really just in very bad taste that he would talk about how there was no inflation during this great expansion through the 2010s. It was all financed by easy money and by cheap labor overseas. And now the easy money is going away and that cheap labor is going away. And inflation here, folks, it's here to stay. Inflation is not going away. They dumped a few million barrels of oil from the Strategic Petroleum Reserve to bring gasoline prices down. It helped with the poll numbers. It helped with the energy inflation. But you notice core inflation continues to rise. The price of all the other stuff is still going up. So I found that comment very odd that he would refer back to that. I got to send a shout to Aaron Levi. I hope I said that right. Well, got one of those was right, hopefully. It says the U.S. 10-year inverted the 30-year just now. This is big. All right, let's look, Aaron. That's a good call, and thank you for the heads up information. Here we are looking at U.S. government bond yields, and the 10-year is sitting at, I can barely see the 10-year. Put your spectacles on, Jack. The 10-year is at 3.508, and the 30 is at 3.498. You are right, sir. The 10 has flipped the 30. Keep in mind, folks, that's known as an inversion of the yield curve when the short-dated Treasury bonds have a higher interest rate than the longer-term stuff. That's very unusual, and that means something bad is coming. And you can see the whole curve is inverted right now. We've got the 1 year broke above 4%, 4.08. The 1 year flipped the 2 year. The 2 year flipped everything. I'm sorry, the 1 year did not flip yeah, it did. Yeah, the 1 year has everything flipped. Jeez. The 3 month is at 3.2. The 6 month is at 3.8. The yield curve right now, the interest rates in as high as they are in the short term versus what they are in the long term. This is the debt market telling us something bad, something really bad is going to happen in the next few months to a year. That's what this is telling us.
Well,
right?
it's actually telling us some different stuff too, because if you actually look at the curve, there's actually a second bullwhip forming. There's one at the 1 and 2 year down into the 6 months, but there's another one at the 30, 20, 10.
Yeah, you got the 10 is lower than the 20, and then the 30 is lower than the 20. So you've got that second wave coming up this string, if you will, right? Like waves traveling back and forth on a string. That's bad things getting closer. That's what that is. So that was a very heads-up data point there, Aaron Levy. Aaron. Thank you, Aaron. I apologize for the butchering of the names, folks. I don't get out much. I sit here and I read news all day. That's kind of my thing. So you'll forgive me if I mispronounce any of your names. But I appreciate very much the support of the channel, guys. Please remember to like and subscribe while you're here. We do this all the time. And there's my man, Cheese. What's going on, Matt? He says politicians are just a bunch of Clints.
I would have said Vince, but, you know.
It's Clints. See, I got to touch up on my Urban Dictionary. I don't know what a Clint is. Did I just get my channel flagged for vulgarity? I don't know.
No.
But okay.
If you use the L and the I, it makes a different letter.
Yeah, okay. I got you. Yeah, it's that word that's like guaranteed to end your marriage in one syllable. I see. Yeah. Hold that one in reserve, guys. Let me just throw that out there. Don't go there.
Don't come out with that one.
Yeah. That's
So you want to do a quick review before we sign?
Yeah, that's a bridge that burns itself as you cross it. Oh, man. All right, we need to get off that word. Let me just double check here. I did get to all of them. All right, let's see what the indexes are doing, folks, because, oh, my, how do you even read this chart? Do you remember when I said I try not to trade right after the Fed starts talking? Well, this is why. Look at this. Nobody can trade this. It's down big. Then, it comes back up, and now it's back down again. What a mess. Let the dust settle before you get involved. Not a financial advisor, not financial advice, folks, but that is how I approach events like this. There will be plenty of movement after. S&P right now is down 36 points or 0.88% at 38.22. The U.S. dollar index was all over the place also while he was speaking. It got as high as 111.5 something, almost 111.6. Now it is, right back at 110.99. Again, this is the highest it has been since the very early 2000s, since the dot-com bubble, and I believe the weighting in the index has changed dramatically during that time. So really, this is the highest it's ever been because there is no comparison with the current euro weighting and the current Japanese yen weighting to really base that on. The 10-year yield is at 3.51. Gold was all over the place. Gold came back big time while Powell was talking. Right now, it's up $14 on the day or 0.87, but well off the highs of the day, trading at 1685. The Dow Jones Industrial Average also swinging all over the place during Powell's speech. Right now, it's down 285 points at 30,420. We're coming up on that all-important psychological barrier of 30,000. We cross below that, well, that is a bad sign. Oil was actually relatively tame while Powell was talking. I did see a little bit of movement, but no big swings. Still at 83.42. I'm going to have to study that chart a little bit more. I have been trying for weeks to call a bottom in oil. I feel like we're close, and maybe the fact that, it looked like we got a little bit of support at 82.5 there, maybe that's a bottom. I'm not calling it yet, but we're close. Just not calling it yet. I'm really holding that one. And NASDAQ down 66 or 0.58%, now at 11,360. Now, this 11,360, this is a relatively important level because we're coming up. Okay, we got a few hundred points below here to get to that bottom from June. The June bottom, 10,000, about 10,650 was the bottom in June. That's an important level, folks. I think we're going to test that one very soon. If we break below that 10,650 roughly mark, don't hold me to that exact number, but if we break below that, there is a long way to go down in the NASDAQ from there. And I heard nothing today, and I mean nothing from Powell that tells me we're not heading there. So we'll see if that level holds when we get there. Again, didn't hear anything that really changed my mind. And silver was having a pretty good reaction. Silver really enjoyed whatever it was Powell said. I don't know what the metals traders heard Powell say that they liked. I really honestly didn't hear anything particularly dovish from Powell today, just that he was not over the top hawkish. And maybe that was enough to give silver this little rally up 58 cents on the day or 3%. Also keep in mind silver right now, the LBMA, the London Bullion Metals Exchange Association, I butchered that name. The LBMA and the COMEX, they are both bleeding out inventory of both gold and silver right now. There is a big drain on precious metals from west to east, I suspect is what's going on. I think banks and financial institutions here in the States are trying to suppress the price by selling it. And I think central banks in places like Russia, China, and India are buying them up like crazy. And that has been going on for the better part of a year and a half now. It seems to be accelerating. Keep your eye on the inventories of gold and silver. We could see some movement in price very soon. Although if stocks were to sell off majorly, as I suspect they could, that will have a momentum impact. It will drag metals lower. Although in the long term, I think metals is the place to be. All right, I got a couple of supers here I got to catch up on. You guys are hard to keep up with today. Let me make sure I don't miss anybody. By the way, I did see my one guy was no longer Googling a certain pod. That he mentioned that while Powell was talking. That's good. I'm glad things have improved for you. Look, things always get better. And I have got Mr. Edward Diaz, 1130. Thank you, Edward, for your support of the channel. He says, do you think a global credit freeze is what could come about? And if so, could that trigger a debt jubilee since no one is getting paid, period? A global credit freeze, not global, no, because I see central banks in China are loosening their monetary policy. They're loosening financial conditions. They're making it easier to borrow in China. Japan has yield curve control. So Japan is still trying to expand the money supply, although they may be about to pivot there in Japan. We'll keep an eye on that. So very dovish policy in Japan, very dovish policy in China. The same thing could kind of be said in Europe, right? Europe just bailed out Uniper today, $39 or $29 billion bailout for their energy companies. Europe has no choice. Well, they do have a choice, but what Europe is probably going to do is they're going to try to print their way out of an energy crisis this winter. Spoiler alert, it's not going to work because you can't print BT.
Okay, what? To me in chat, tell me, can you still hear him?
Mish, I think we're still live. I'm not sure if I lost you or not. I'm going to keep going.
We are
I'm not
still
sure where
live. You buffered out there for a second, but you're back.
All right. So what I was saying was everywhere else in the world, I see credit is still expanding, and the U.S. is really the only one who is truly tightening right now. Some countries like Switzerland or Sweden, one of those countries had a really big hike in their central bank rate. So there's pockets of tightening going on around the world, but on average, the rest of the world is loosening still. And that's why you see the U.S. dollar index, or the DXY, is getting so high, because that is Brent Johnson's dollar milkshake theory. With the U.S. Federal Reserve being the only central bank tightening, it's causing other countries' investors to dump their currencies in favor of dollars in order to preserve their spending power. Even though the dollar is being inflated away, it's being inflated away a lot slower than the rest of the world. That's driving the dollar higher versus these other countries. So No, I don't foresee a global credit freeze, but I do think a debt jubilee is very likely because at some point, all of these central banks are going to have to choose between their currencies and their economies. The debt bubble globally has gotten so big, there is no longer any hope of it ever being paid off. Not ever. All right. We will never, ever pay off the national debt in the U.S. We won't. It's going to default either through inflation by paying it back with worthless currency or by just saying we can't pay it back. That's going to happen at some point. I don't know if it happens this year, next year, 10 years, 50 years from now. But it's inevitable at this point. So eventually the debt jubilee happens. I know there's a lot of people who are talking about like the dates and the calendar and some of the religious cycles that are coming up, and it does kind of line up with what we're talking about here. As I hear September 26th is referenced a lot. I don't know exactly what it is they're talking about, but I have heard that phrase debt jubilee an awful lot lately, and there's a lot of people thinking that way, but not quite yet. I don't see a credit freeze, at least not yet. Thank you, Edward Diaz, 1130, for your support of the channel, sir. I really appreciate that, but that was an excellent question. That was a good question. I saw somebody else just came through here. Where are you? Scrolling. No, I guess that was everybody. Did I miss
Nope,
anyone, Mitch?
you're caught up.
All right, I am caught up. It is now, we've been going for like an hour and a half. That's a long stream. I got to catch my breath. I want to say thank you guys so much for your time, for watching. Please remember to like and subscribe to my channel. Thank you to my Patreon supporters. Reminder, guys, 7 p.m. Eastern Time tonight is our Zoom call. I'm looking forward to talking to you guys and to taking your questions and hearing your ideas about what you saw in that speech today. Maybe you saw something I missed. Looking forward to hearing about that. There is a link to my Patreon down below. And just when I try to sign off, just when I try to wrap this up, here you guys go. Jose Orozco, the man with the Buc-ee's corn nuggets. He says Powell owes me a percent of inflation to inches calculators. Let me rephrase that. He says Powell owes me a percent inflation to inches calculator. I believe you are referring to certain politicians' comments about just an inch of inflation, right? Just an inch. Everybody yelled at me because I referred to it as inflationary speaking. It was just the tip, is what Powell or Brandon was saying in that interview. Yes, I would love to see an inches to inflation calculator. That's certainly, I can't give you that formula, Jose. But thank you very much for the support of the channel, sir, and for watching as always. Had a good time meeting you in San Antonio a couple months ago. And there is Lord Hypnotoad. There's a name. Thank you very much for the support of the channel, says Gold, the sober one in the room. All right, let's bring up the gold chart for Lord Hypnotoad. Thank you very much for your generosity, my lord. He says, rolled its eyes at Powell and then went back up to its support. It's had enough. Also, it seems like the market shrugged off Putin's partial mobilization. Interesting comment. You're right. Gold's behavior was very interesting. I was struggling to get my head around what gold was doing while Powell was talking. I'm chalking that one up to the algorithm because if you look, the net movement hasn't been very big after Powell's speech. So I think you probably had a couple of different algorithms were arm wrestling each other, and that was that price swing we saw in gold. Because I didn't hear anything or see anything that changed my opinion of precious metals. I tend to be pretty stubborn, though. Allegedly. That's what Gigi says. Allegedly, I'm stubborn. I'm going to hear her laughing from upstairs in a couple of seconds because she's probably watching this. But yeah, the point about Putin's partial mobilization, we'll keep an eye on that one. I don't want to get too much into that because every time I mention Vladimir Putin, the Russian trolls come out of the woodwork, and you guys are hilarious. You're adorable. I just love it. But 300,000 reservists were called up, and Putin struck a particularly belligerent tone, even for Putin today. Some overt threats, references to WMDs, even nuclear weapons. I heard some Russian media outlets threaten London directly today. So there's been at least an escalation, calling up 300,000 reservists, poorly trained troops, and then just feeding them into the cannons in Ukraine. That is not going to help things. It's not going to make things any better for anybody, certainly not those 300,000 people. So unfortunately, it looks like that situation is going to get worse before it gets better for anybody. Let's just hope that our leaders come to their senses and cooler heads prevail, and I'll leave it at that. Again, I'm not picking any one side or the other. I think they all suck. I wish they would all just leave us the heck alone and let us do business and go about our lives. If we get these schmucks out of the way, you'd be amazed what people can accomplish when they don't have to give half of everything they produce to these guys who take what we produce use it to enrich themselves and slaughter people by the hundreds of thousands. I will get off my soapbox. Thank you very much, Lord Hypnotoad, for your comment and for your generosity, sir. Guys, I appreciate it very much. All right, I think we're going to call it there. It has been a heck of an afternoon. We will have way more to talk about in the future. Looking forward to talking to my Patreons later tonight. And Mish, anything you want to add?
Everybody take it easy. Be careful this week and this weekend. A lot of stuff out there. Cheers.
All right. Salud, guys. Thank you very much for your time. And until next time, live small and dream big.